Real-world assets, or RWAs, is a narrative that could really fly this bull market. And when we saw that one of crypto's leading price tracking sites had published a report about RWAs, we knew we had to take a closer look. So today we're going to summarize that report, explain what it all means in simple terms, and tell you exactly which projects to keep a lookout for. This is a video you don't want to miss. The report we'll be summarizing today is called, quote, RWA Report 2024, Rise of Real-World Assets in Crypto. It was published by CoinGecko on the 26th of March, and we'll leave a link to the full report down in the description, and we recommend you give it a read if you have the time. But if not, then don't worry, we'll be giving you the juiciest bits right here in this video. Now, to kick things off, the report begins with an overview introducing us to RWAs and giving a few points to illustrate their importance. As the authors explain, real-world assets represent tokenized versions of tangible assets in the physical world that are brought on-chain. In plain English, RWA tokens represent things like stocks, bonds, and real estate, which can be traded on smart contract blockchains like Ethereum. The authors begin by outlining the history of real-world assets, explaining that they've been around since 2014 in the form of stablecoins, which are, of course, just tokenized US dollars. The authors also note that Tether actually issued the first USDT tokens on the Bitcoin blockchain. Fun fact about that, USDT was originally launched in July 2014 as Realcoin before rebranding to Tether in November that same year. Anyway, the report also explains that there are stablecoins that are pegged to things other than fiat currencies, such as Paxos's PaxG, which serves as tokenized gold backed by real physical gold that's stored in bank vaults. As another fun fact, the gold backing PaxG is secured in Brink's vaults in London, and you can even redeem your PaxG tokens and have Paxos literally send you physical gold. Anyway, during the euphoria of 2021, some lending platforms, such as Maple, Goldfinch, and Clearpool, allowed institutions to borrow funds without the need to put down assets of their own as collateral. Then, in 2023, some platforms began to offer tokenized treasuries, which offered exposure to treasury bills once their yields started to exceed those in DeFi. Analysis shows that from the start to the end of the year, the total value locked for tokenized treasuries soared by 641%. And by the way, if you're enjoying the video so far, smash that like button to give it a boost. And while you're there, subscribe to the channel if you haven't already and ping that notification bell so you don't miss our next video. Hold up a second there, Guy. Sorry to interrupt, folks, but I just wanted to very quickly tell you about the Coin Bureau deals page. Now, this is the place where we have put together some of the very best deals and promos in all of crypto. So you can think things like exchange sign-up bonuses, trading fee discounts, and money off of hardware wallets, and much, much more besides. So if you want to check that out, coinbureau.com/deals is the place to go, or you can just use the link in the description of this video down below. Thanks very much, and now back to you, Guy. Anywho, the report's authors then go on to split a number of RWA projects into 7 categories. These categories are tokenized treasuries and securities, private credit, real estate, exchanges, stablecoins, regenerative finance, and arts and collectibles. Now, we won't go into every entity in each of these brackets for the sake of time, but as you'll see here, there are a few well-known companies in each, as well as some that many people probably won't be too familiar with. The authors also note that this list isn't exhaustive and doesn't represent the entire RWA space. That being said, it does offer a good oversight into just how many projects fall into this niche. Moving on, the report then compares companies offering fiat-backed stablecoins and commodity-backed assets. In the pretty handy table they've created, each company is explored to see which stablecoins are offered, what chains they can be found on, as well as a few other details. So, to use Tether as an example, you can see it offers fiat-based stablecoins such as USDT, EURT, CNHT, and MXNT, as well as its gold-backed stable asset XAUT. Tether's reserves are collateralized as cash and cash equivalents, US Treasury securities, corporate bonds, secured loans, and BTC, while its current custodian is Cantor Fitzgerald. Tether provides RWAs across 14 different blockchains, has no governance token, and has some fairly competitive minting and redemption fees. On the other hand, meanwhile, the second largest stablecoin issuer, Circle, offers just two fiat-backed stablecoins, USDC and EURC. Circle's reserves are collateralized as cash and cash equivalents and US Treasury securities. Their current custodians are BNY Mellon, Customers Bank, and Cross River Bank. They provide stablecoins across 13 different blockchains, have no governance token, and have even better fees than Tether when it comes to minting and redemption. Next, the authors assessed the market caps of fiat-backed stablecoins. The report notes that, as of the 1st of February, their total market cap was $133.6 billion. Today, they have a value of $140.2 billion, at least at the time of shooting. Now, obviously, stablecoins are predominantly made up of USD-pegged tokens. The top three stablecoins, namely USDT, USDC, and DAI, account for 95% of the market share, with USDT single-handedly making up 71.4%. To the author's credit, they also point out USDC's depegging in March last year. What's crazy is that stablecoins in other fiat currencies, such as the euro, the Chinese yuan, or the Mexican peso, collectively make up just 0.2% of the overall market share. The authors also take a look into the parabolic growth of stablecoins in 2020. For reference, at the start of that year, stables sat at a collective value of $5.2 billion, but reached a high of $150 billion just over a year later, an increase of 30x by March 2021. When it comes to commodity-backed tokens, meanwhile, the authors comment that these can fluctuate in value depending on what the underlying asset is doing. As of the 1st of February, the total market cap for these assets was $1.1 billion. This accounts for just 0.8% of the market cap of fiat-backed stablecoins, so they're really being dwarfed in comparison. In fact, the market share of commodity and non-USD-backed stablecoins hasn't really changed. In other words, they don't seem to be growing any faster than USD stablecoins. Nevertheless, 83% of the market cap of commodities is made up of just two gold-backed assets, Tether's XAUT and Paxos's PaxG. The authors note that different commodities will be backed by different amounts of precious metals. As they put it, quote, XAUT and PaxG are both pegged to the price of 1 troy ounce of physical gold, while other tokens, such as Kinesis Gold, KAU, and Vera1, VRO, are pegged to the price of 1 gram of gold. The next section of the report looks at tokenized treasuries. These gained traction during the bear market as investors looked for a low-risk way to earn a steady yield on their assets. Notably, these come with more regulatory scrutiny and, as such, KYC on these is mandatory, and there may also be limitations on who can actually invest in them. CoinGecko lists 7 providers for tokenized treasuries. These are Franklin Templeton, Ondo, MatrixDoc, Bakkt, Hashnote, OpenEden, and Superstate. Each treasury offers a modest yield within a range of 4.7% to 5.4%. What's intriguing here is that Franklin Templeton is the largest issuer by a wide margin and also seems to be the only one to not offer its product on Ethereum. Anywho, the following page explains the structure of tokenized treasuries. Basically, issuers will work with brokers to trade their assets under management, or alternatively, they can directly subscribe for treasury purchases from the US government. These assets are then stored with a custodian who will have an updated list of holders and their balances. The fund manager will then work directly with the custodian for various operational tasks, such as onboarding new users. Now, it's important to note that tokenized treasuries aren't actually backed by the treasuries themselves. Rather, they're backed by a money market fund set up by the issuer. These funds are capital market products with their own rules and regulations, and this is why KYC is a necessity. Next, the authors dig into the market caps of these tokenized treasuries. Again, the date they reference is the 1st of February, when there were $861 million of treasuries on-chain. As mentioned earlier, these saw parabolic growth of more than 6% during the bear market. Franklin Templeton controls a 38.6% share of the market with $332 million of tokens issued. It's also revealed that most protocols are primarily based on Ethereum, which hosts 57.5% of the market share. However, a few, such as Franklin Templeton, have instead opted to use Stellar, which holds 39% of the market share. Not bad at all, considering how Stellar doesn't seem to be the choice for most treasury issuers, but also not that surprising considering that Stellar has been trying to secure institutional partnerships like this for years. Okay, so the next section of the report looks at real-world borrowing using on-chain platforms. The first part looks at private credit protocols. These work a little differently to over-collateralized DeFi loans, as they instead allow real-world businesses to obtain unsecured loans based on their credit history. The report names 7 of the top private credit protocols: Maple, TrueFi, Centrifuge, Clearpool, Goldfinch, Credix, and Florence Finance. The authors then provide this infographic that details the bridge between real-world borrowers and on-chain loan providers. Basically, protocols will create a lending pool which they'll either manage themselves or delegate to a reputable third party. Then, users can deposit funds into the pool as liquidity to be lent out to borrowers. In return, lenders receive liquidity provider, or LP tokens, which represent their share of the pool. Borrowers who are interested in taking out a loan are assessed by the pool manager before they're accepted. Then, once the terms of the loan are agreed, the borrower receives funds from the lending pool, which they'll then have to pay back with interest. When the lender redeems their LP tokens, they withdraw their share of the pool's funds. Next, the report looks into the total active loan value of the top 7 private credit protocols. The authors note that, quote, on-chain private credit reached new heights in 2021. However, they subsequently suffered significant defaults once the crypto market crashed in 2022, but are now seeing a recovery. As of the 1st of February, the total active loan value was at $446 million. The report notes that the demand for leverage from crypto trading firms saw a meteoric rise in the run-up of 2021, most of which was facilitated by TrueFi and Maple, who provided 86% of the total active loans across the market. In the aftermath of Terra, 3AC, and FTX, Maple suffered a $10 million default, and the total market value of active loans crashed by 82.7%. Ouch. That said, the authors also note that active loans are making a bit of a recovery, with the value increasing by 60% by the end of 2023. This is mainly thanks to real-world lending firms like Centrifuge and Goldfinch, with the former making up 53% of the overall market share. Now, to the analysts' credit, they provide an in-depth breakdown of borrower demographics. What's interesting is that 42% of private loans were used for cars, which is the largest use of these loans by quite a wide margin. The second and third largest usages were for fintech and real estate at just 19% and 9% respectively. What's crazy here is the difference between the demand drivers. That's because over the last year, there were 60 automotive loans taken out for cars, with over $168 million lent out. However, there were no loans taken out whatsoever for the second largest demand driver, fintech, in 2023. Another crazy statistic is that while there were a total of 840 loans taken out last year, only 10% of these loans are currently active. The other 90% have either been repaid or defaulted on in the wake of Terra and 3AC. In regards to geographic location, meanwhile, most of the loans were taken out by firms from emerging markets, such as the whole of Africa, who took out over 40% of all loans, whereas countries like the US only have 1 active loan. Now, real-world assets can be used for more than just offering services from the real world. The next section of the report looks at how some projects can actually help to heal the world itself in a new sector called regenerative finance, or ReFi. These projects aim to address social and environmental issues by leveraging blockchain technology. The report notes that there are 4 areas that ReFi projects will focus on to help regenerate good old Mother Earth. These are tokenized environmental credits, if you catch my drift, ocean and marine conservation, renewable energy, and public goods funding. Starting with tokenized environmental credits, these projects incentivize institutions to reduce their environmental impact and can register their excess credits on-chain, which can then be traded on a marketplace. Next, ocean and marine conservation projects aim to use blockchain technology to reduce the damage to our planet's waters. Plastic removal can be tracked on-chain, and marine life is protected by projects tracking seafood sustainability. There are also projects aiming to protect marine biodiversity through blue environmental credits. Then we have renewable energy projects that track and share verifiable on-chain data on renewable energy, even allowing companies around the world to purchase tokenized versions of this energy to help power and scale up their businesses. The final ReFi category, meanwhile, is public goods funding. These projects aren't necessarily focused on environmental impact, but rather on offering on-chain resources to others. So, for example, by matching public donations or incentivizing project developers to build on open-source software. ReFi projects like these stand to make the world a better place and remind us that crypto really can make a difference. However, this assumes that the real-world assets backing these cryptos are legitimate. Recent studies into Verra, the world's leading standard for climate action and sustainable development, have shown that over 90% of its environmental credits are completely worthless. Okay, in the next section of the report, the authors note that, on top of the traditional financial products we've seen tokenized on-chain, the crypto industry has also seen an increase in the number of capital market products being experimented with over the last few years. In 2021, Société Générale issued a €5 million medium-term note on Tezos. This was a key driver for the development of Forge, a regulated subsidiary offering crypto-based services ranging from crypto asset structuring, issuing, and custody. Then, the European International Bank, or EIB, issued a €100 million 2-year bond on Ethereum. This was done in collaboration with giants such as Goldman Sachs and Santander, with the move being geared towards the dystopian rollout of CBDCs. In 2022, KKR tokenized part of a $4 billion fund to further offer out to individuals, albeit you had to have a minimum of $100,000 and funds went through a 1-year lockup period. Also in that year, BNP Paribas issued tokenized bonds for solar energy projects. UBS London issued $50 million worth of tokenized debt securities, and Rabobank issued €40 million of commercial paper on-chain. Things continued in 2023 when ABN AMRO released a €450,000 digital bond on a public blockchain, Siemens issued a €60 million 1-year bond, and the Hong Kong government issued a tokenized green bond worth 800 million Hong Kong dollars. On the following page, the authors note that, quote, a big portion of tokenization experiments by TradFi has been conducted on private blockchains instead of public networks, leading to debates surrounding security. They then compare the pros and cons of TradFi institutions using either private or public blockchains. We won't unpack everything here for the sake of time, but here is a quick TLDR. Basically, if TradFi institutions opt for using private blockchains, they'll benefit from enhanced privacy, obviously, and simplified consensus mechanisms, such as using proof of authority. This makes everything run in a straightforward manner. But the trade-off is obviously centralization. Now, this might sound like something TradFi would opt for, but remember that this means there are fewer points of failure. A few bad actors or a malicious bug could easily cripple the network. On the other hand, if TradFi institutions instead go for a public blockchain, they would benefit from heightened security. As the authors of the report put it, quote, "In general, a key component of a public blockchain's security is strength in numbers, where a large number of node operators secure the network. The trade-off here is that, well, it's more public. This is because with public blockchains, everything is publicly viewable by all, something that might not always be ideal in this situation. Not only that, but the more people there are using the network, the more congested and expensive it will be to use." With BlackRock recently launching its tokenized BUIDL fund on the Ethereum network, however, it looks as though public blockchains will be the way forward, especially considering that it drew in $245 million of deposits in only its first week. Moving on, in the next section of the report, the analysts at CoinGecko look at real estate and tokenized goods. These are the more commonly discussed use cases for RWAs, and the analysts have divided these into 4 categories. These are real estate, arts and collectibles, luxury goods, and fashion. Each category has its own description and a few examples of projects fulfilling that particular niche. Starting with real estate, the authors explain that tokenized versions have the benefit of increased liquidity and fractionalized ownership. Put simply, you could buy up, say, 10% of the tokens for an office block, and you'd have 10% ownership and would therefore get 10% of any income that property makes. Anyways, the authors note 2 projects that approach real estate RWAs in different ways, with one converting paper deeds into digital tokens and another focusing on offering alternative methods of real estate payments using crypto or even NFTs. Next, we have arts and collectibles. This allows for the fractionalization of things like fine art or collectibles like trading cards, which means they're a lot more liquid and accessible when it comes to trading. The authors note a project dealing with collectible cards, allowing users to trade those cards on-chain while the physical cards are kept in insured vaults, and another project that offers fractionalized fine art on Ethereum. The next category is luxury goods. Similar to fine art, this allows for fractionalized ownership of some expensive products, such as watches, and can verify those products' authenticity on-chain. And the final category is fashion, whereby unique items can be tokenized into NFTs, which gives fashion designers the opportunity to bundle unique digital experiences when ownership is verified. Again, the authors note 2 projects in this niche, one that merges fashion and gaming, and another that merges luxury fashion items with NFT technology. Now, the next page of the report takes a look at the price returns of some RWA governance tokens. Interestingly, the authors note that, quote, "While the overall RWA market cap has grown significantly, none of the RWA governance tokens have posted a positive return." They then go on to explain that RWA governance tokens from the 2021 cycle took a brutal hit from the bear market, and despite having rallied since the start of the year, they're still mostly down by 90% from their all-time highs. Okay, so that just about rounds up the review of the last few years for RWAs. But what about the future? Well, in the final section of the report, the analysts give their take on what the future of RWAs could look like. They start by reiterating that fiat-backed stablecoins are not only the most simple form of RWA, but also the most popular. In their words, quote, "Their importance to the crypto industry cannot be overstated." They go on to say that while more issuers have become comfortable with crypto, more real-world assets have been digitized on the blockchain, primarily in the form of debt or credit. Some of this debt is low risk, offering a stable yield that's especially useful during bear markets, while other debt carries much higher risk, but with yields that can compete more with DeFi. Notably, the authors reflect that this could be seen as a representation of the current investor base and the assets which appeal to them. The authors also note that other tokenization efforts of credit, such as corporate bonds, environmental credits, or real estate, have yet to find their place in the market, despite having been around for some time now. As the demographic of investors becomes more diversified, so too will the risk appetite. The authors comment that this could be a chicken and egg problem, as if there's no on-chain demand for quality RWAs, there won't be many being tokenized, and vice versa. This makes sense. Consider that rather than holding a tokenized treasury, you can currently earn a higher yield by lending out USDC on DeFi protocols, without having to go through any onboarding or KYC. The report notes, however, that the most encouraging developments for RWAs are the recent moves towards the tokenization, custodial and payment space by TradFi giants like Franklin Templeton, PayPal and Standard Chartered. If all goes well, this could boost the confidence of regulators and investors alike. This is very much needed because arguably the biggest hurdle RWAs face, outside of demand drivers, is regulation. And finally, the authors discuss where RWAs fit into the current landscape. They write that the future of RWAs is dependent on how projects can incorporate third parties such as oracles, custodians, and credit assessors, which they say are inevitable. As they put it, quote, "How these are effectively utilized and managed will remain a crucial element for their continued operations." So, this brings me to the big question. What does all this mean for crypto? Well, the short answer is that real-world assets are set for rapid expansion. As the hype continues to build around RWAs, the number of assets being tokenized is only going to increase. And because tokenizing assets on the blockchain unlocks additional opportunities through smart contracts, it won't be long before more companies see the value of crypto and jump on the bandwagon. This will drive up investment into RWAs from crypto natives and simultaneously boost adoption for retail and institutional investors not already involved in the space. The active involvement from TradFi giants like Standard Chartered, PayPal, and Goldman Sachs in tokenizing stocks, loans, and real estate proves that confidence in blockchain is already growing and isn't slowing down anytime soon. Of course, the main hurdle that RWAs have to overcome is, like I said, regulation. That being said, though, the more institutions that get on board, the more likely it is that regulators will get their heads together and come up with some real frameworks. This won't only help RWAs, but crypto as a whole. Yes, there's probably still a long road ahead of us before we get full regulatory clarity, but this is definitely proving to be a step in the right direction. During this bull market, we'll see more solid projects pop up as they use RWAs to serve a real-world purpose. Make no mistake, some of these projects will have 100x or even 1000x potential. And you can learn more about some other narratives we're bullish on by watching the video linked to below. The key will be doing the due diligence needed to filter out the ones that simply jump on the hype, as opposed to those projects that offer genuine utility. It will be fascinating to see what the space looks like even 1 year from now. Who knows, when next year's report comes out, it could all look very different. And that's all for today's video, folks. So if you learned something new, show it by smashing that like button. If you want to see more educational content like this, subscribe to the channel and ping that notification bell so you don't miss our next release. If you're actively trading crypto, then head on over to the Coin Bureau deals page. It has trading fee discounts of up to 60% and sign-up bonuses of up to $60,000. Be sure to take advantage of these limited time offers before they are gone. The link is in the description. So, with all that said, thank you for watching and we'll see you in the next one. This is Guy, signing off.